Welcome to the Staying Ahead by Thinking Differently panel. I'm Yakob Peterseil. I'm an editor at Bloomberg News. Now, innovation has been central to the ETF industry from the very beginning. In fact, it's often easy to forget just how revolutionary and game-changing the first ETFs were back in the early 90s. Since then, we've had kind of a steady drumbeat of progress. Today, for example, we have ETFs that actually pay you to invest. We have products that don't have to disclose their holdings every day, and that's just stuff that's come out or been approved this year. So innovation is alive and well in this industry, but it can be a double-edged sword, as we know. Last year, there was the controversy about the inverse VIX products in the US, which some saw as an innovation too far. But that's exactly what makes this such an interesting topic to debate. And to do so, please join me in welcoming my panel. To my right, Lidia Treiber. Lidia is Director of Fixed Income Research in Europe for WisdomTree, one of the major ETF-only shops in the world. And prior to WisdomTree, Lidia had a similar role at Invesco. So welcome, Lidia. And in the center, we've got Alexander Gaillard. Alexander is CEO and founder of InvestGlass, an innovative company which is a toolkit for wealth managers to help automate their sales processes, in part through the use of ETFs. So welcome, Alexander.
Thank you.
And finally, at the end, we have Odette. Louis is head of ETF analysis and strategy for EMEA at Citigroup. Louis's group produces some quite influential research on the market, and Citi was named Global ETF Research Provider of the Year in 2019. So welcome, Louis.
Thank you.
So why don't we start? I think we can broadly sort of define the ETF value chain into three parts. We've got the manufacturers, the designers, we've got distributors, and finally we've got the use of ETFs. Now each of these are sort of in various stages of flux and change. Why don't we start with manufacturing and design? Lidia, a lot of attention has historically been given to equities in ETFs. We're starting to hear more and more about fixed income. Flows have been massive this year for various reasons. Over at WisdomTree, sort of, what's the state of the art in fixed income ETFs, and what do you see happening?
Yakob, I think this is an important topic. In terms of fixed income, there's been significant flows. So this year, there's been over 60 billion in flows just into fixed income ETFs, which is the largest on record. So the asset class now stands at over 200 billion US dollars. It's still only 25% of ETFs in Europe, but as you can see, it's growing and there's a lot of interest. So at WisdomTree, when we develop fixed income ETFs, we do it with more of a macro type driven investment approach. And we think about the best way to index. In fact, we're pioneers in self-indexing, which is essentially a balance between active and passive. So within this space, for example, when we see a flaw in a traditional fixed income ETFs, where it was mentioned in the previous panel, where it's more market cap weighted, there's a significant amount of exposures to the largest indebted countries, corporates, etc. For example, right now with government bonds, European government bonds, a lot of European government bonds are negative yielding. And a lot of these market cap approaches expose investors to large weights to these negative yielding bonds. So what we've devised is an optimized approach, and we've done this through our enhanced yield suite. So for example, we look at the Euro government or the Euro ag, and we tend to tilt the weights to the higher yielding bonds. But what we do is we also maintain risk constraints to make sure that, for example, you're not getting significantly increased volatility versus these traditional market cap weighted approaches. So I think this is gaining a lot of interest, especially because of the fact that there is such a large portion of negative yielding debt right now in the market. Also for when there's an asset class that there's not an existing ETF available and we're providing market access to this specific asset class, we will devise a market cap weighted approach, but allow the investor to be able to gain access using the benefits of the ETF, which is that transparency, that intraday trading, et cetera. And we've done that. For example, we launched an AT1 COCO ETF, which provides investors with exposure to a diversified pool of AT1 COCO bonds issued by European banks. We also did the same recently. We launched an ETF that gains exposure to US floating rate notes. And so this is the first time that an ETF has provided this type of exposure to European clients. So I think, in areas such as this, we try to be innovative and try to think of ways that we can provide clients with interesting solutions in the fixed income side.
Yeah, and so this may not be quite yet a huge concern in the fixed income space, but there are certainly areas of the ETF world where innovation has sort of risked going too far, and I alluded to the inverse VIX products, for example, in the US. ETFs are a great democratizing force, but there's a point where it can go too far. Lewis, I mean, you're sort of an observer of this industry. How careful does the ETF industry need to be about pushing innovation in product design or manufacturing too far?
Ultimately, I think innovation needs to provide a solution for investors, and that can be in the form of access to a particular segment of the market, or it can be in the form of an enhanced risk-return profile. And then ultimately the market then decides whether or not that innovation is needed and desired, and investors buy the ETF or they don't. That being said, you mentioned some of these geared products, that sort of thing, and I think one thing that would be very helpful is an enhanced taxonomy around exchange-traded products. So that's a big ask, given that many people have just stopped calling them EFTs. That being said, I think distinguishing between plain vanilla exchange-traded funds, exchange-traded commodities, notes, so on and so forth would be very useful.
Okay. And there's an argument actually that perhaps the flaw lies in the distribution. Perhaps we should control who has access to some of these, funkier ETFs. Do you think that's one possible solution, or do you think, who bears responsibility in this?
That's a great point. I mean, ultimately, geared products do what they say on the tin for the most part. So if you have an inverse product and the reference asset goes up by 100%, guess what? That inverse product is going to zero. That being said, I do think things like point of sale checks are a good idea, and many brokerages already implement those in one form or another. And ETFs and exchange-traded products should not be a backdoor into riskier strategies that an investor could not access directly.
And there's an argument that on the portfolio level, isn't the best portfolios the most boring ones, like the ones that where not a lot of this going on, there's not a lot of churn? Does that sort of run counter to the argument for innovation in this industry? What does the panel think broadly?
I mean, from my standpoint, I think there's a balance between innovation, right? I think there are benefits, and I think providing clients with more innovative solutions just means that they have more options of ways of investing, right? So traditionally, they may have accessed this particular asset class through an active manager, or they looked at a solution and it would be purely passive. And I think this was mentioned many times where in some cases, purely passive is absolutely fine to gain exposure, but sometimes there's parts of that index that an investor may not want to gain exposure to. And so having some sort of an innovative solutions provides an additional solution for clients. I think what that means is that clients just need to be a bit more judicious in terms of doing their due diligence and determining whether these specific solutions make sense for them, because not all innovative solutions are created equally. Some solutions might increase volatility significantly, others might control for risk, and I think each investor has to review these solutions and say, well, these make sense for me and these might not. So I think it just provides clients with more options. Now, in terms of which ones perform better, I mean, there's certainly cases where you look at the historical performance of some of these innovative ETFs, and you can see that they have, in some cases, provided quite attractive returns relative to purely passive. So I think there is a benefit to having these solutions out there. I just think it means that investors just need to do due diligence to make sure that they're selecting the right solutions for their needs.
Alexander, you work with asset managers. Is boring best when it comes to portfolios?
Well, Donald Trump is going to run for another presidency, and quantitative easing is all around the place, so it's going to be harder and harder for all of us to get somewhere and start somewhere, getting back into the track of the markets. So we can be as creative as we want. At the end, I mean, from our point of view, ETFs is just a fantastic way to reduce cost of managing the portfolios. We see our clients, the first question is they say, what is the TR of the ETF? the total expense ratio being one of the major issue, and then creativity, of course, but it's a trade-off. Creativity means that you're going to sell a service, okay? From the 10 past years, we've seen a lot of creativity, obviously, but there's a cost. And actually, it's great that you have this creativity, because otherwise, all those ETFs are commoditized. What all the ETF asset managers are selling in reality now is a service. If you don't sell a service, your ETF is dead. The same way, separately managed accounts or old-style management just went bankrupt in a way because of ETFs bringing those creativity. Mm-hmm. So, boring, I don't know. I think the most important is protect the client's assets to make some yields or performance in a way or in another, and be very careful where you put your assets. The previous panel was talking about private equity. We're seeing more and more creativity now in the private equity, but most of the time we don't say that it's private equity debt, not private equity assets. So coming back to what you say, it's extremely important to be as transparent as possible into what we put into the product. Now, I think that already into the market, there are a lot of things being done thanks to the MiFID, in the MiFID area. Perhaps in Switzerland we have to improve, but if you go to the MiFID area and you start to selling ETNs and ETCs to your clients, you should have flags normally everywhere in terms of pre-advice, in terms of pre-trade. So I think it's not constraining and say like, you know what, because you don't have 10 million on your bank account, you're going to have a boring ETF management.
Okay.
And Robo Advisory can be a very interesting point to talk now about.
Indeed. So let's turn to Robo. Let's turn to the distribution kind of piece of the puzzle. There have been massive changes in this, as we've discussed, in the distribution chain, and Robos have been instrumental. The traditional manufacturer, distributor, end user relationship, you have told me, is broken down. So can you tell us a little bit about what you were seeing on the distribution side and what things are changing?
Well, we've seen a lot of failures. Robo Advisory has not been a success unless you are Schwab, Vanguard, and all those big asset managers where basically you are at the source of the ETFs. But it has been a failure. We have to recognize it. It's a fantastic glazing to facilitate onboarding of clients. Now, should we reject Robo Advisory? Well, that would be stupid. We see like 3 types of people. We see global warming skeptics, AI skeptics, Robo Advisory skeptics. There's the same group. We see those that they know Robo Advisory exists, they know global warming exists, perhaps not 2 weeks ago in Zurich, but it's too big for them to encompass, to embrace the change. So we say like, we put it on the side. And there's a third type of people, and I hope that you're all of those, who say like, well, retirement is in 10, 20, 30 years. I need to improve my business process. I need to find a way to enchant, I'm bringing Donald Trump again, to bring banking in Switzerland back again, making good again, great again. Okay. And I think that Robo Advisory could be a solution. And the second challenge of that is not too much, because usually we always think about millennials and how we're going to... No, the problem is not millennials. The problem is us. Who will be the next relationship managers? How are you teaching the next generation, the next relationship manager? How do you teach them? And what you're going to teach them is not only from ETH, HEC. No, it's not schoolbook stuff. It's on the market, how you share this experience. And I think that you're going to see new hybrid type of robo-advisors that won't be only like click and play invest, but will be more some kind of all relationship managers bringing wise advice, young bringing opportunistic views, and one will know how to protect the market, will understand ETCs and ETNs and ETFs and stuff like that. The other one will say like, you know what, there's Jewel, 40 billion under management. Snapshot, have you heard about Snapshot? Amazing. And it will bring something different to those portfolios and creativity to those portfolios. You've
brought up a lot there, and which I want to get to later in the panel, but related to robos and also in product design is this concept of AI, and I wanted to turn to the poll question because we have one for this panel. So if I could ask you in the audience to take out your phones, please, and I'm going to pose this one to the panel too, but we want to hear from all of you. So go to the event app on your phones, polling section, future of ETFs.app. And the question is this: do you consider artificial intelligence, AI, an innovation in investing or marketing? Is AI an innovation in investing or marketing? And while we wait for those numbers to come in, okay, cynical bunch, why don't we, Lidia, product design, does AI playing any role in what you guys are doing there?
Yeah, so I think in terms of AI, we recently launched an ETF that focuses on investing in AI companies. And I think from an investment standpoint, what solutions need to consider is making sure that these companies that claim to be focused on AI actually offer a significant portion of their revenue streams coming from AI solutions. And I think that's where the difficulty comes, because there's so many companies saying that they're AI, there's just so many, and you have a pool of options to select from. And I think the most important thing when selecting a solution is to make sure that there has been some rigorous analysis, some sort of criteria to filter out the companies that are not AI. From a marketing standpoint, and I think the audience has a similar view, that it's also playing into the marketing aspect of many companies. So having this information allows companies to be able to, provide very targeted marketing to their clients, and they can do that using multi-channel marketing. And that makes things much more effective, because in the past, I think marketing was more focused on, very general, very broad. Now things can be much more customized, and that's much more effective. When you're looking at something on Google and an ad pops up because you've been researching something, a product, etc., I think that just makes it more relevant, because then there's so many products out there, there's so many options, that if you can actually have someone kind of filter those options and say, have you considered this solution? Have you considered this alternative to something you've researched? It just makes your life a little bit easier too. So I think certainly AI is playing into both things. Investment solutions for these companies that are well placed and can grow and they can profit from this growing innovative change, and also from companies that just want to use these solutions to improve their marketing campaigns.
So what about using AI in actual portfolio selection? Is that something that is happening now or should be happening?
Well, I'd actually agree with the audience here. I think it's a little bit of both, right? So the world is generating so much data these days, and a lot of techniques are being rolled out to attempt to harness that data. But in my view, interpretability is key. There are some techniques that are bound to be overhyped and will probably go away over time. But really having that domain expertise and that knowledge of what the data represents is the first step in terms of harnessing it. And I'd highlight two films that sort of illustrate this. Most people have heard of Moneyball, how the Oakland Athletics used quantitative techniques to build their baseball team on a shoestring budget. But there's another Clint Eastwood film called The Trouble with the Curve, where he's an old curmudgeon baseball scout, but he knows what to look for in the player. So, you don't want to overly rely on heuristics, but that domain knowledge is key. And one final point I would add is beware of solutions in search of a problem.
Sure. Now turning...
I want to comment on this one.
Yes, please.
I don't completely agree with you guys. I mean, unless someone here can use AI to make performance, just come to me and I'll open an account with you. Because in reality, you do? Okay. But in reality, yes, if money markets are back to 4% and you want to implement some crazy hedge funds techniques, then fantastic, let's put money with you guys. But in reality, we see the hedge fund market today is absolutely a dead zone. So is AI actually bringing a better investing, innovation, creativity? The answer to my understanding today is absolutely no. And to tell you a little story, in 2008 I was in Boca Raton working for Levitt Capital. It's a global macro hedge funds. We were doing global macro top-down, very traditional stuff. And I remember Bear Stearns went bankrupt, and I was at the same time eating my kale salad in the library, reading books, and I found for the first time a book about Daniel Kahneman and Anne Mostrewski. Never heard about those guys in 2008. Big books about heuristics. And I came back to Robert Levitt. He was on his Bloomberg working, and said, I found a way to make money. Heuristics. We're going to use this, behavioral finance. And he told me, Morgan Stanley people tried it, JP Morgan people tried it. No one is actually making money with it. I went back to my salad, and then I said, well, I have an idea. I know what we're going to do with behavioral finance. We're not going to do investing stuff. We're going to do marketing stuff. And because perhaps I was in the US mindset, I said like, well, you know what? We're going to use this to actually improve the way we are actually selling innovative ETFs, creative strategies. Basically, I mean, I'm sorry to be very blunt, but it was very much like, how are we going to sell storytelling bullshit to customers to improve the process of selling? And actually, this is effective, and this is working. And this is the reason why we are still here trying to sell funds to our clients. It's not because we do better ETFs here. It's the same index, unless it's ETNs or synthetics and stuff like that are slightly different. But the reality is the stories, the values we share at the right time to the right customers, which means that when we deliver the right story with the AI, they buy it from you.
Okay. That's an interesting perspective, Alexander. Thank you. Turning to round of applause. Turning to a slightly more mundane topic. So to the way investors, the end of the value chain, the way investors are actually using and trading ETFs. And Louis, I wanted to pose this to you. People have used ETFs over the years for a variety of reasons. There have been the long-term core holdings. There have been the tactical usages. People buy them on exchanges. People buy them on RFQs here in Europe. What are you seeing in terms of the way people are actually investing in and trading ETFs today that's changing?
As you mentioned earlier, ETFs are a very democratic product. So you have hedge funds, institutional investors, individual investors, all in the same ETFs. That being said, we do break down the use cases broadly into two categories. So you have allocation products, so sort of long-term, low-cost holdings, substitutes for traditional funds. And then you have trading or capital markets products, which are used much more actively and traded much more frequently, sort of substitutes for futures or other derivatives. So in terms of some of the innovative use cases that we're seeing more recently, I'd say harnessing the ETF ecosystem, particularly where that's very well developed in the US. So helping to offset management fees and earn some extra income through things like lending out ETF shares as well as options overwriting types of strategies. Also, one thing that we're seeing more and more of is liquidity sleeve usage in active portfolios to eliminate cash drag. That's a big change. I remember when I first started following ETFs, active managers didn't want to hear about them. They were the enemy, but slowly but surely they found ways to incorporate them into their portfolios. Fixed income is an area where you're seeing a lot of innovation. So even just looking at ETFs for informational purposes, because they trade throughout the day, unlike many bonds. And then things like portfolio trades and securities sourcing via ETFs. And then also relative value trades versus the cash bond market or other index products within fixed income. And then finally, to echo some points made in some of the earlier panels, I think trading is also getting more sophisticated, and a realization that you can selectively and strategically give your trading counterparties some information to help improve your outcomes and look at all routes to market, whether that's agency trades, risk trades, or NAV trades.
And you mentioned the ecosystem. How is that coming along in Europe? Because ETF lending is sort of notoriously underdeveloped here in Europe because of the geographical difficulties. How is that coming along? Is that growing? Do you see potential for it here to really burst?
Yeah, you do have listed options in Europe, and you do have a securities lending market. That being said, it's not the same extent as you have that in the US. I think it's a little bit of a chicken and the egg problem around securities lending. Investors would like to borrow ETFs, but then they go to agency lenders and either the price is prohibitive or they're just not really invested in that business and don't have the inventory on hand. So I do think getting that right is the key to really unlocking the full potential of the ecosystem around ETFs.
Got it, yeah. Now going back a bit to the title of this panel, which is Staying Ahead by Thinking Differently. Lydia, I wanted to pose this question to you. So WisdomTree is quite unique in the ETF world. It's a dedicated ETF shop, and in many ways it seems as sort of a bellwether for the ETF industry as a whole. And it's obviously a lot smaller than larger, more diversified firms such as a BlackRock, a Vanguard. Has that been an advantage for the firm in terms of innovation, in your view?
I mean, I think that's a good point, and I think we get that question a lot. I think we do think it is a benefit. I I think the main point is that we are the largest independent ETP provider globally. And I think because of the fact that we focus solely on ETPs, that really allows us to kind of focus all of our resources on innovating in this space. So when we come up with solutions, we're literally researching, what's available in the market, how products have performed, what are some of the flaws. We really do a significant amount of research before we provide solutions to our clients. And we try to find, the best solution. There's no conflict of interest of other aspects of the business. We literally only focus on ETPs. And I think this is where, like I've mentioned before, we've been able to really innovate. So for example, when we came up with, the first exchange-traded product that focuses only on AT1 COCO bonds, before, the only way that investors were able to access this market was either buying individual AT1 COCO bonds, which means you'd have to put a lot of capital out because each individual COCO bond has a minimum clip value of 200,000. So you actually had to either have a significant overexposure to a single issuer, or you had to allocate a significant portfolio value in order to have a diversified portfolio. Also, there are significant active managers in the AT1 COCO space, but there was no ETF. And so we were the first to come to market, and we did a lot of research and were able to innovate and provide this type of solution for our clients. And the same thing that we do with, a lot of the other products that we have. So for example, the enhanced yield suites. These products, they're resonating really well with clients because we've focused on something that's, a bit more unique, a bit more innovative, and clients are looking for something that's providing greater yield, especially within fixed income where yields are just at historically low levels.
And so you see a lot of the more innovative products coming from a WisdomTree, even the white label issuers. Can a firm like a BlackRock, a Vanguard, are they nimble enough to compete with them?
What we see more and more from those firms is model portfolio distribution. So they don't sell only the actual item, they sell the recipe, and then wealth managers that are the distributors basically can pick in the recipe and build their own magical sauce around the ingredients that are prepared from the asset managers. This is common in the US, and we see now this starting in Europe. Again, I think it's an interesting way because as an asset manager, you could know better what is exactly inside and optimize the portfolios with those proposals. So we see this manufacturer, distribution, and client type of exchange and value chain that is changing with more information that is being prepared and sent to wealth managers.
Great.
And to touch on that again, another thing that we're focusing on as well is, for example, we've developed this new technology that allows investors to look from an open architecture standpoint how to construct a portfolio with ETFs that are not just WisdomTree.
Okay.
And so this is something that we've recently launched in Europe, and it covers all the key asset classes, equity, fixed income, et cetera. And so investors can go on our website and select, whether it's a few of our funds, a few iShares products, a few Vanguard products, et cetera, and construct ETF portfolios and, be able to allocate across different asset classes to optimize and reach certain client targets. So I think, this is something that providers like ourselves and like many others in the industry are trying to find ways to be open with clients and provide not only our solutions, but also the best solutions, and open architecture is some way that we've been able to kind of achieve that as well.
Sure, and I wanted to get in one last question before we run out of time, and this is a bit of a reflection on what's come to date in the ETF industry. I asked the panelists, what's one innovation in the ETF space that you thought was a real game changer that really sort of jump-started things, going back from the early 90s? Louis, what was the big game changer, the big innovation in the ETF world for you? What was most important?
For me, it's physical precious metals, particularly gold. Looking at that, historically, investors had to get access to that market indirectly via the miners. And then once you saw the gold ETPs launched, then you saw those mining stocks derate and you saw the assets balloon into gold. So I think that's a great case study for an access vehicle that can be provided by an ETP.
So access, Alex?
I remember buying Bovespa from Amundi the first time. It was a synthetic. I was quite blown away to buy a synthetic of Bovespa that was basically 80% of Saint-Gobain and Total behind.
Okay.
I would say for me, the active ETF. So this is something that in the US and they have it in Europe too, it's still a very small percentage of ETFs in Europe, but having an actual fully active ETF where you have a portfolio manager that's looking to outperform a benchmark. And the only difference between an active mutual fund and this active ETF is the actual fact that it's an ETF wrapper. So the prospectus has an investment objective similar, exactly like an active fund. Everything is very similar. They run through the same risk management process, etc. And it's just in an ETF wrapper. So the client is able to see daily transparency of all of the holdings of this active fund, which I think sometimes with the active mutual funds, when you're trying to see the holdings, and I've tried to do a lot of competitive analysis against some of the funds, it's difficult to get some of these holdings on a very current basis. Sometimes the holdings are a few months delayed. And so being able to see the risk exposures that you currently have in your portfolio is challenging because you don't really see what actual bonds are in your index or what actual equities you're invested in.
Sure. So the active ETF. Then.
So the active ETF is interesting. To me, it was quite innovative.
Great. Well, huge round of applause to the panel. Thank you very much.